Stocks ending the week on a positive note. We did get the latest read on U.S. inflation that points to further progress and encourages a lot of investors to believe that the Fed will cut rates as early as September. TSX Composite hitting a record high today. Our guest says we are seeing gains coming in beaten-up value names in sectors such as rails and base metals. We're joined by John Zechner, chair and founder of Zechner Associates. John, thanks very much for coming on the show.
Pleasure, Andy.
So we have seen, obviously, this tech-dominated market in the States. There were signs over the past couple of days the gains are broadening out. But talk to us about Toronto. You feel investors are moving into rail stocks again?
Yeah, the bit of cyclical moves, Andy. I mean, these last 2 days in the market have been very interesting. I mean, everybody wondered yesterday because it was such an odd move. You saw how long has it been since you saw the NASDAQ down with the big tech over 2% in a day, while the small cap value Russell 2000 was up over 3%. I mean, that's the complete opposite of what we've seen for most of the past 2 years, quite honestly, outside of the rally in the fourth quarter of last year. And all that, I think, was predicated on the move on the lower inflation number that came out Thursday morning, and then suddenly with recent comments from Powell and his testimony this week, Jerome Powell, the market really believed that September is close to 100% lock on the first cut in interest rates. So, here the interest rates they've been waiting for close to a year, it looked like they could be finally coming, and that sort of lit a bit of a fire under some of these other, cyclical names, consumer names, and others that have, suffered while just only big cap tech has had to run. So when you get that, Andy, Canada does better. And I heard your prior conversation about how the TSX has actually done better on a broader basis this year, which is true. I mean, you look at the equal weighted TSX is actually doing better than the capitalization weighted TSX. Whereas in the U.S., I think in the first half you had the S&P 500 up about 15%, but the equal weighted S&P 500 was only up 4%, which tells you all the gains were concentrated, as everybody knows, in a narrow group of big tech stocks.
I mean, the market often welcomes weak economic news because it encourages interest rate cuts, but there's a dark side to that, isn't there?
It's a real glass half full, half empty, Andy, today, and I guess it was half full because you're absolutely right. The weak economic data we've seen, and we've seen some sloppy data lately. I mean, the ISM in the U.S., both the manufacturing as well as services, are below 50. You never have that happen without going into recession. The U of Michigan confidence indices this morning, again, going to 2-year lows. We've seen weak data there. The recent employment reports were softer. I mean, you've seen increase in bankruptcies in Canada and the U.S. Credit card delinquencies are going higher. I mean, the economic numbers are softening. I mean, I don't see any other way around it. The markets tend to look at this, okay, that means the Fed's going to cut interest rates sooner, and that's going to lift financial assets, as opposed to looking at maybe the other side, which is the glass half empty, maybe my view of what does this do to corporate earnings. And we got a taste of that this week. I mean, look at the Pepsi, look at the commentary from Delta Airlines, look at the past couple of weeks, Starbucks, Nike, names like that. And then the bank earnings today. I mean, what did they talk about? I mean, good capital markets, which helped them beat the numbers, but it's been a bull market with daily highs in the U.S. So the big sort of the major banks that are involved in capital markets to a large degree, like J.P. Morgan, I guess Morgan Stanley, Goldman Sachs, and Citi had reported today. Yeah, sure, they'll hit their numbers, but below the surface, I mean, net interest margins are getting squeezed because they have to pay a lot more to attract deposits, and loan loss provisions are going higher. And that doesn't read well for the Canadian banks because we haven't been as big in the capital markets, are certainly not enough to offset our exposure on the loan loss sides. That's a bit of a warning flag for when the banks, start reporting their next quarters, which I guess are end of July quarters. So.
You have been moving back or upping your holdings in gold, John, including Torex Gold and B2 Gold.
Yeah, Andy, of all the data we see, the one thing I feel most comfortable with is that the U.S. economy is finally catching up on the downside to what we've seen in the rest of the world, what we've seen in the emerging economies, what we've seen in Europe, what we've seen in Canada, Japan. The U.S. is slowing down, which means to me you're finally going to take the high off this U.S. dollar as they start to cut interest rates. One of the biggest tailwinds for gold in an absolute basis, obviously, is the move in the U.S. dollar. That declines, that's the lift of gold. On top of that, gold stocks are basically on a valuation basis at 4-decade lows. I mean, you look at something like the GDX, the biggest ETF for gold stocks in general, it's trading lower today than it was when gold was at, I think, $1,600-$1,700 last. So, I mean, the gold stocks are undervalued to not only for the past couple of years, but the past couple of decades. And on top of that, you've still got the central bank buying, particularly China. I mean, with all these foreign economies, foreign central banks, they want to get out of their holdings of U.S. Treasury securities because of the massive borrowing going on there, and they want to diversify a little bit. And these guys have been the de facto buyers of U.S. debt for decades. And if they, not only stop buying, if they actually start selling, that's obviously a bit of a problem for the U.S. dollar as well. So in that whole environment, Andy, gold's got to stick out, and it's acting well. Just the stocks aren't acting well. It's fine. I'm patient. We can wait this one out.
Yeah, it's interesting. Zimbabwe apparently is launching some kind of a gold-backed currency. Of course, it's had hyperinflation in recent years. Uganda upping its gold holdings. So it seems to be a worldwide trend, central bankers buying more bullion.
Particularly the emerging economy central banks. I mean, China is leading but you're absolutely right. There's all these others. They've been big holders of U.S. debt and U.S. dollars, and they've got to diversify away from that. And gold, among other things, is probably a good diversification because there's not a lot of other currencies right now that sort of stick out as necessarily as great value because you're cutting interest rates in Europe as well. So you're trying to stimulate the Chinese economy, which is obviously, suffering from its own debt crisis, is overloaded on that basis. So, yeah, gold sort of does stick out, and especially in a hard asset world, is probably a good, safe investment and an offset to what you're seeing in the financial assets.
Could you just give me, I was just thinking about mining takeovers here, John. I'd love to get your take on this issue. As you know, the Canadian government's indicated it's going to be a lot harder possibly to buy big Canadian miners producing critical minerals. The TMX group has expressed reservations about that. What do you think? Do you think there'll be a backlash for the government if it makes it harder to buy these miners?
I don't necessarily think so. We're only down to a select few of names that really would garner that international interest at this point. I mean, it wasn't that long. I guess it was about a decade ago, Andy, when we saw, the Falcon Bridge, Inco, Alca, and all of these guys disappear. And then, I guess it was, around 2005, so it was longer than that. And then the government sort of blocked potash being sold. So I guess, they're putting the line in the sand. No, Canada is not for sale. So, this probably impacts Teck Resources to some degree. Maybe to the largest degree because it's the biggest player out there and it's sort of one of the most natural targets. But I like Teck in here separate from that. I mean, I think getting out of their metallurgical coal assets, for the old Fording coal assets, is a great move at exactly the right time from ESG perspectives. As you know, it focuses them completely on copper, zinc, and to degree gold as well. And I think it'll get a higher global valuation even without a takeover. We need something to invest in here, and it's nice to have companies like that of decent size. So, but I agree with you, Andy. I mean, the indication you're getting is you're not going to see takeovers allowed of big Canadian metals companies, and a lot of these things would, attract a lot more scrutiny going forward.